Welcome to The Explainer. I am super excited about today's deep dive. We're putting on our expert investment analyst hats and performing what I like to call a rigorous clinical stress test. Our subject today, Olema Pharmaceuticals, ticker symbol OLMA. We're going to take the legendary, tried-and-true investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham and crash them headfirst into the high-stakes, volatile world of clinical-stage biotech. We're going to see exactly what comes out on the other side.
Okay, let's dive into this. How exactly do you value a company that currently brings in absolutely zero revenue? I mean, it's the ultimate riddle for value investors, right? Olimma is a clinical-stage biotech company developing targeted therapies for women's cancers. They don't actually sell a commercial product yet. Their entire existence, basically the whole shebang, is a massive bet on the future.
And honestly, that creates a fascinating paradox. Over the trailing 12 months, OLMA has posted a massive net income loss of negative $162.45 million. Ouch! But then you look at the other side of the coin, and almost 92% of this company is owned by institutional smart money. We even saw Paradigm Biocapital recently dump an estimated $13.35 million into the stock in a single quarter. Clearly, Wall Street sees something huge that a basic income statement is just completely missing.
So our baseline for today's test is exactly $11.82. That's the current stock price of Olimma, giving it a market cap right around $1 billion. Everything we calculate today, every single model, every checklist will be measured against this exact number to determine if Olimma is a buy, a hold, or a sell.
But before we run the numbers, you really have to understand what that billion-dollar valuation is actually built on. It all hinges on their lead pipeline candidate, a drug called palazestrant. It's currently in a pivotal phase 3 clinical trial called OPERA-01, targeting ER-positive, HER2-negative metastatic breast cancer. If this drug succeeds and snags a 2027 approval, the company practically prints money. If it fails, the entire investment thesis collapses. It is a true binary event, all or nothing, boom or bust.
Section 1. The Value Investor Stress Test. Applying Buffett, Lynch, and Graham.
Fair warning here, these classic value frameworks were built for evaluating railroads and consumer goods, not modern biotech, so things are about to get a little ugly. We start with the Oracle of Omaha, Warren Buffett. Now, Buffett looks for a predictable economic moat, consistent earnings, high return on equity, and manageable debt. Well, Olimma has absolutely no moat yet, because, you can't have a moat without an approved drug. Earnings are consistently negative. ROE is a brutal negative 42.86%. The literally only thing they pass is manageable debt, which is incredibly low at just $4 million.
But here is where Buffett's model completely breaks down. He calculates intrinsic value using owner earnings, which heavily relies on free cash flow. For Olimma, trailing 12-month free cash flow is negative $78.8 million. You simply cannot calculate a margin of safety on a company burning that much cash with zero revenues coming in the door. Through a strict Buffett lens, the buy price for Olimma is exactly $0. Next up, we pull out the Peter Lynch lens. Lynch would categorize Olimma as a highly speculative fast grower. Now, we can't even calculate his favorite metric, the PEG ratio, because, well, there's no price-to-earnings ratio to divide by a growth rate. Furthermore, Lynch famously loves stocks that Wall Street completely ignored. Olimma's institutional ownership is nearly 92%. For Lynch, a crowded trade like that is an immediate red flag and a definitive avoid.
And this brilliantly illustrates the one massive redeeming quality Olema possesses under the Lynch framework, a fortress balance sheet. They are sitting on a mountain of cash, $505.3 million in cash and short-term investments, weighed against the microscopic $4 million in total debt. That gives them a staggering current ratio of 10.88. They have the financial runway to actually see their phase 3 trials through to the very end, which is the absolute lifeblood of any clinical biotech.
Finally, let's run Benjamin Graham's defensive investor checklist. Graham demands safety above all else. Olimma actually passes the adequate size test with $1 billion market cap, and they easily pass the financial condition test thanks to that massive cash pile we just talked about. But they fail spectacularly on earnings stability, they pay absolutely no dividends, and their price-to-book ratio is elevated.
If you want to see exactly why classic value investing fundamentally ignores clinical biotechs, just try running Graham's famous intrinsic value formula. You multiply 22.5 by the earnings per share and the book value per share, and then you find the square root. But Olema's EPS is negative $2.02. If you try to find the square root of a negative number, your calculator literally just gives you an error. Graham's model mathematically rejects the stock.
Section 2. Discounted Cash Flow Valuation. The Modern Scan. Clearly, backward-looking models just don't work here. To value a biotech, Wall Street looks at what the company will be, not what it is today. So the crucial point is understanding the assumptions we absolutely must make to build a discounted cash flow or DCF valuation. Drawing on our data from Stock Sentinel, our base case assumes palazestrant gets approved and achieves a target revenue of $850 million by 2031, with a solid 25% operating margin. We also have to account for future dilution by projecting 110 million shares. Most importantly, we must discount those future cash flows back to today using a high weighted average cost of capital, or WACC, of 12%. Why so high? To properly penalize the stock for those massive clinical trial risks. So when you run those projected cash flows through the DCF model, the base case fair value per share comes out to $34.77. Compared to our $11.82 baseline, that represents a massive upside of roughly 194%. Boom. This is exactly why institutional investors are piling in. They're looking way past the current cash burn and pricing in a successful, orderly commercial launch.
But let's see how this builds when we adjust our assumptions in a sensitivity table, because biotech valuations are incredibly fragile. If the clinical risk seems lower than we thought and we drop the discount rate to 10%, the fair value absolutely skyrockets. But if we bump that discount rate up to 14% to account for, say, a potential delay in the FDA process, the fair value plummets. It perfectly demonstrates just how volatile financial modeling is when you're relying entirely on a drug that hasn't even been approved yet.
Section 3. Alternative Valuation Models, AI Scenarios, and Wall Street Targets.
Now, what's really interesting about this slide is the sheer scale of the delta between failure and runaway success. To round out our diagnostic tests, we can't just rely on a single DCF. We need to look at probability-weighted scenario modeling. Using Stock Sentinel's AI scenario modeling, the low case, where the OPERA-01 trial fails and the pipeline is totally impaired, drops the stock down 90% to just $1.15. That essentially values the company just for the remaining cash on hand. But the high case? A broad label blockbuster approval sends the value rocketing up over 830% to $110 a share.
And where do the human analysts land on all this? The consensus Wall Street price target from 12 analysts is currently $40.70. They hold a unanimous, strong buy rating. That represents a 244% upside from the current price, which tells us that institutional researchers are heavily weighting the probability toward clinical success rather than a failure.
Section 4. Synthesis and Final Recommendation. The Final Diagnosis. Okay, we've run the gauntlet of backward-looking legends and forward-looking models. Here is your ultimate summary of fair values across the board. The divide literally couldn't be starker. If you look purely at present-day earnings and stability, Buffett and Graham value this at exactly 0, and Lynch says avoid it completely because of the crowded institutional trade. But if you look to the future, the DCF base case sees $34.77, and the analysts see $40.70.
Ultimately, the decision comes down to how you weigh these specific strengths and risks. On the plus side, Olema has an ironclad balance sheet with over $500 million in cash. They are addressing a massive unmet need in breast cancer, and the absolute smartest money in biotech is backing them. On the downside, this is a 100% binary play. They are burning $45 million a quarter, and if that phase 3 data is bad, the stock will crater, likely leading to severe shareholder dilution just to keep the lights on.
So, what is our final blended verdict? Well, for a strict value investor, this is an undeniable avoid. But for the risk-tolerant biotech investor who understands scenario modeling, Olema is a speculative buy at $11.82. The upside potential vastly outstrips the downside risk, provided you can stomach the wild volatility. I want to leave you with this provocative thought to chew on. When it comes to investing in life-saving science, is the pursuit of tomorrow's incredible innovation worth completely ignoring the safety of today's cash flow? Thanks for joining this explainer, and we'll see you next time.